Hello, everyone. Justin with Deep Dive Stocks here. And today we're going to be doing the last of the warm up videos where I am acquainting myself with how to make these things. And to do that, we're going to be doing a tier list. Yeah, another tier list. This one instead is going to be on different option strategies. So we're going to be ranking just different common option strategies that you see in the market, and I'm just going to rank them based off my personal experience with them, and that's about it. So, if you disagree with any of the rankings or opinions, definitely let me know in the comments below. And yeah, other than that, let's get started. First up is the double diagonal. We can see that here. Here's the P&L graph for the double diagonal. We can see that there are two strikes, so there's two dashed lines, and we can see that the green zone, or like where the profitability is for this type of option strategy, is confined within two price points. And that's because a double diagonal is a two strike option strategy that has four options involved, and the goal is to essentially profit in so long as the price stays within two other strikes between two price points. And in so long as the price remains within those two price points, then you profit. It's pretty easy. Double diagonals, actually a pretty big fan of double diagonals. I think they're pretty versatile. The one downside to them is that they are sensitive to IV changes. Specifically, double diagonals will lose quite a bit of value if volatility decreases. And so, but on the other side, it will gain value if volatility increases. The conundrum of this, though, is that because your profitability is between two price points, when a stock typically becomes range bound between two price points, volatility typically falls, which typically drops implied volatility. And so you are kind of inherently working against the same dynamics that you are trying to profit from. Because as the price stays between those 2 points, volatility is likely going to start declining. When volatility declines, your double diagonal is going to start losing value. But nonetheless, I still think they are pretty versatile. And even though they're four options, they're not too complicated. So I'm going to put double diagonals in the A tier. What is next? We have the covered short call. And we can see from the P&L graph that this has one strike, namely the strike that you or an investor sells the call at. And we can see that as the price of the equity decreases, or increases rather, as the price moves to the right, the value of the position decreases. And this is because as the price increases, then the value of the call that you sold, the price of that call is going to increase because it's presumably becoming closer to being in the money. And so since you've sold that call and that call now has greater value than when it was sold, this means that you are losing value as the price appreciates. And that's exactly what we see here in the P&L graph. Now, short covered short calls are a pretty potent staple in the market. And the idea is that if you are bullish on a equity, the equity is only going to go up typically um, in a certain reasonable fashion. And so if you can jump ahead of the expectations and then sell a call, then you can collect the premium. And even if the price appreciates, as long as the call expires out of money, you get to collect the premium. The downside is if the call becomes in the money, then you might have your call exercised, in which case you have to fork over the collateralized shares, the covered part of the covered call. And I'm going to be honest, this is, like I said, it's the predominant way people use calls in the market. Just premium harvesting, and for me, I'm not very good at it. It takes a lot of maintenance. You have to watch it constantly. I'm gonna put it in C tier. you have to watch it constantly. You're always on edge on whether or not do I want the price to go up? Do I not? My shares do, but my options don't. Overall, I just don't think the juice is worth the squeeze with covered calls. And so I'm going to go ahead and put that in the C tier. It's too much work, too much balancing. It's too much of a balance act for me. But yeah, I mean, some people swear by it. Who knows? Next up, we have what is this? The call spread. We can see that the call spread consists of two strikes because there are two dash lines. And if the price decreases, then we see that there is a negative P&L for the position. And if the price increases, then we see there is a positive P&L for the position. And I'm a huge fan of covered calls, vertical spreads, bull spreads. They just have a very nicely defined risk structure. You know exactly how much you're going to lose. And I like that. There's no surprises. The lack of surprises extends to the upside as well. So you can see in the P&L graph, there is a limit to how much you can gain with a vertical spread. But for me, I think vertical spreads are a nice way to capture price movement without having to worry about a lot of the other nonsense that can sometimes come with options. And so you're essentially just looking for a leveraged way to participate in price action with a defined risk structure and a defined profit structure. And I think that's glorious. I think that's great. So I think I'm gonna put call spreads in the S tier. I just feel like that's right. You're not really, because you're not affected by volatility that much. You're not, theta works in your favor if you start getting in the money, but say you're like a week or 2 weeks early before expiry, you can just wait and then theta will bump the value of your position up. They're just nice. They're nice little gadgets. Alrighty. Next up, the younger brother to the double diagonal, which is the single diagonal, or also known as the calendar spreads. Just like the double diagonal, the idea is that the profitability lies in the price not moving that much. And ideally, you want the price to not move that much from the strike price that you set the calendar spread at. So there's one strike price for the calendar spread and two options. And the idea is that you buy the calendar spread and you wait. And if the price stays near the strike price, then ultimately you should profit. And if not, then you're not going to profit. Like I said, with the double diagonals, I'm a fan of the calendar spreads. They are straightforward. They're pretty simple. You can collect a good amount of P&L from them. They do suffer, just like the double diagonals, from the volatility relationship, where even though you want the price to stay within that range at the strike price, in doing so, oftentimes volatility will decrease. And this, of course, will decrease the profitability of the calendar spread. So, it's kind of like a Goldilocks zone to figure out, you want. So it's kind of like this Goldilocks zone that you have to find. Price stagnation without volatility decreasing, which can be a little tricky sometimes. So I'm gonna put that. I like calendar spreads though. Is it as good as a double diagonal? I'm gonna put it in the B tier, just because it has less versatility. Um, yeah, B tier. Alrighty, what is next? What is this guy? This is the naked long call. And let me make this bigger. This is pretty as straightforward as it gets. It has one strike, one option. You or a person or investors purchase the call, and if the price goes up, then there is profit, and if the price goes down, there's not profit, unprofit, right? And in a similar way to the calendar spreads, the naked long calls also suffer from this paradoxical, yeah, I guess it's a fine word, relationship with volatility, where the value of a long call increases as the price appreciates, but typically in the market, as the price appreciates, volatility will decrease, and this typically will lower the value of the call. And so calls are pretty prone to what is known as volatility crush or IV crush. And that's where the decline in volatility is so substantial that it actually removes any profitability regardless of how high the price has appreciated. So the call may be doing well in price action, but because volatility is decreasing so much, ultimately the value of the call is worth. And so this kind of makes a situation where there's, at least in my head, no reason to do a naked long calls when um, call spreads exist. The benefit you get, the potential benefit you get from the long call is that unlimited upside. But again, unlimited upside just isn't actually a real thing. It's like a mathematical concept. And then two, you're going to be fighting volatility the whole way unless the price appreciation is so substantial that it increases variance and IV starts increasing. But that's a pretty uncommon event. So I'm going to honestly put long calls, naked long calls in the D category. I'd rather sell calls than go long on calls for sure. D tier. It's too much. It's too much for too little. Alrighty. Next up we have, whoa. Alrighty. Alrighty. And next up we have the Strangle or the Straddle. I always mix them. In either case, two strikes, two options. You, on the left hand side, you purchase a put, and then on the right hand side, you purchase a call. And you can see that the idea is as long as the price moves in either direction, there should be profitability. But if the price stays, within the range of those strikes, then then you're essentially you bought two worthless options, and so your loss is going to be the amount that you paid for those options. The benefit of this strategy is on paper that you can open yourself up to moves and profitability in those moves in both directions. And again, this is one of those, at least for me, whenever I tried this, it was one of those things that always felt like it should work better than it ever was working. I think that's predominantly because, yeah, I'm not a fan of these. These strategies always felt too unconfident enough, is the word I'm looking for. The idea that you are opening yourself up to profitability in both directions kind of implies that you don't know which direction the price is going to go. And I'm not a fan of trading in those environments. So even like if even if these situations are, say, like during earnings where, you're definitely gonna get maybe some, not definitely, but where the probability of getting a significantly large move is substantial. But again, you kind of end up in a situation where if the price appreciates, you're going to see a huge IV crush, which means your of the straddle is going to underperform. Next up is a short iron condor. And these are similar to your calendar spreads where the name of the game is to profit from price not moving. And so we can see in the thing right there, the I'm pointing to my monitor. I don't know what you guys are looking at. We can see that there's four strikes, and coincidentally, there are also four options involved. And the name of the game is really just the price stays between those 2 points and cha-ching, positive P&L. And the cool thing about the short iron condors is Whereas with the calendar spreads, the calendar spreads profited. The win condition for them was an increase in volatility. The short iron condors, it's the decrease in volatility that increases the short iron condor's value. Try saying that 10 times fast. And so, and like we said, when price is not moving that much, IV typically naturally drops. So whereas, you know, so whereas with the calendar spread, this was something that the position would fight against, this decrease in volatility. The short iron condor benefits from it. So as volatility decreases, the value of the position increases. And since that's what usually happens when the price stagnates, it can be pretty beneficial. The downside to short iron condors is that they are pretty somewhat complicated to set up. It is premium harvesting, so you do sell it, and then you have to wait for them to expire or to get to a point where you repurchase the position to close out. And you can get some decent plays with this. It can be tricky. You got to be quick though with short iron condors, from my experience. They're very sensitive to IV, and if IV drops, or if spot drops and then IV starts skyrocketing, you got you got seconds to get out of that short iron condor. They can be pretty brutal. I guess that's like the biggest downside to them, is you can do very well collect like harvesting premium with them for like a month straight, and then one crazy afternoon and you've kind of given back a good portion of all that premium by trying to exit the position. So it can be tricky. So I'm going to put it in the B tier. I like that I think it's fair to put it in the same as the calendar spread, because they're, two sides of the same coin. Alrighty. Next up, we have the naked long call. You can see that here. The naked long put. And yeah, one strike, one option. The idea is you purchase a put, and if the price decreases, everything is green, positive P&L. If I think I drew this P&L graph wrong. Yeah, I did. Look at the colors, not where the lines are. The idea is the put will gain value as the price depreciates, and unlike calls, since price depreciating typically is met with a increase in volatility, and since an increase in volatility increases the value of long options, the put doesn't really fight against its own price action in the same way that calls do. So whereas with calls, if a long call sees price appreciation, it will typically also experience a decrease in volatility. Thus, the price action, which increases the value, is competing against the decrease in volatility, which is decreasing the value. The long put doesn't really find itself in that position, because a decrease in price increases its value, and an increase in IV increases its value. And it just so happens that an increase in IV is typically what happens when the price falls. The downside, though, is that when puts lose money through, adverse price appreciation or decrease in volatility, when those two come together, it can be pretty disastrous. So, but I'm gonna put long puts in the A category. The benefit of having spot and IV working together really can make some powerful plays with puts. And next up is the butterfly spread. And you'll notice that the butterfly spread, the P&L looks like a hybrid between the calendar spread and the short iron condor. And that's kind of because it is. I always think of butterfly spreads as the long version of the short iron condor. You have 3 strikes, but 4 options. And so the strike in the middle is essentially a calendar spread. And so it's a little Frankensteinian monster. And I don't use them much. Uh, the yeah, a C tier for me. And so that's that. We have a pretty stacked board actually. I'm pretty surprised. We have in the D tier, the Naked Long Call. It fights too much against its own existence for me. The Straddle Strangle, whichever one it is. I don't. It's D tier for me. I don't just simply because I'm not a fan of the directionless output, or I'm not a fan of the directionless outlook, and also it works against itself. I just D tier for me. C tier, we have that short call, which is only really a C tier for me personally because it just takes a lot of observing and maintenance, and the my brain doesn't work good for that. So C tier. The next up in the C tier is the butterfly spread. Again, it's a mix of the calendar and the short iron condor, but it's a long position overall, and it's it's fine. I'm not a huge fan of it though. I think that I would rather either do a calendar spread or a short iron condor versus kind of doing both. And so C tier for sure. Next up, we have the B tier. That was the calendar spread and the short iron condor, kind of the bread and butter in terms of premium harvesting, theta, theta gang. They're pretty good. And so the A tier is the double diagonal. I just like it a little better than the calendar spreads because it has it has a little wider um breadth of success, and it's not terribly complicated to set up. You're really just purchasing two calendar spreads slightly separated. So then also in the A tier is short, the naked long put. The P&L graph being inverted is kind of cooking my brain a little bit, but the long put is in the A tier because unlike the call, it doesn't fight against its own price and volatility dynamics. And so you can really get some nice um, P&Ls from puts. And, I didn't even mention it during the ranking, but if puts are to hedge a position, IV can kind of make it to where the hedge can be profitable along top of the hedging. So you can get something that goes from insurance to profit. And it's all based thanks to IV, which I think is pretty cool. And that's just impossible with calls. But speaking of calls, in S tier, we have the call spread. And the call spread is S tier because it's, I think, straightforward. It's simple. A lot of it is easy to navigate. It's a great introduction into multi-legged option spreads. And I don't find myself stressing over spreads nearly as much as I do all of the other types of option strategies. But so yeah, all right. That is the tier list for option strategies. Thank you for hanging out. This probably won't be the last tier list. So if you have any ideas for more, let me know. But after this, I'm gonna start making a little bit more serious videos. I definitely need time for another LDPM, LDPS video. So without further ado, actually, that's not what you said. So, all right, guys, thanks for stopping by. Leave your comment in the comment below. Leave your comment in the comments below if you agreed with any of this, if you disagreed with any of this, and just let me know how you do. So, all right, I'll see you guys later.